Okay, we are recording. Hi there, everybody. I am doing this recorded lecture for Chapter 4 of our payroll textbook. And so in Chapter 4, we're going to get practice calculating federal income tax. And as we'll see in the PowerPoints and as we start to get practice on some of these in class together, there are a couple different ways that are used to calculate federal income tax, the wage bracket, and then the percentage method. And so we're going to get practice, obviously, doing it both ways. And we start Chapter 4 next week in class together. So I am going to share my screen with you and get the PowerPoints pulled up, and we will go over these together. So Chapter 4, again, we're looking at income tax withholding. And so, again, for the most part, this is dealing with federal income tax withholding. There can also be state and local income tax withholding, but this chapter focuses mainly on the federal income tax withholding. And so some of our learning objectives, we're going to look at coverage under the federal income tax withholding law by determining the employer-employee relationship, the kinds of payments defined as wages, and the kinds of pre-tax salary reductions. Learning objective 2, explain the types of withholding allowances that may be claimed by employees for income tax withholding and for the purpose and use of the Form W-4. Number 3, compute the amount of federal income tax to be withheld using the percentage method and the wage bracket method. Those are the two most commonly used. However, there's also alternative methods such as quarterly averaging, annualizing of wages, and part year employment, and then the withholding of federal income taxes on supplementary wage payments. And then learning objective 4, explain the Form W-2, the completion of the Form 941, which we've already got some practice with, major types of information returns, and the impact of state and local income taxes on the payroll accounting process. All right, so coverage under the federal income tax withholding law. So employee-employer relationship must exist for federal income tax withholding laws to apply. Basically, if the employer has the right to, essentially, direct the employee's work hours, what they should be working on, they're considered to have the employee-employer relationship. And I was just trying to find real quick in our book where that is at, so I can point you to the correct page. Where did it say? Oh, so it's on page 2 of Chapter 4. It says if a business has the right to control and direct the worker, it meets the definition of an employer under the common law criteria. So again, that relationship, if the employer has the ability to direct and control the employee, then that relationship exists. Statutory non-employees having no federal taxes withheld, so direct sellers and qualified real estate agents. And then taxable wages for federal income tax withholding purposes. Gross amount of the following items are taxable, so wages and salaries, vacation allowances, supplemental payments, bonuses and commissions, tips, cash awards, taxable fringe benefits. And then it talks about some of these taxable fringe benefits. Let's see, where does it have it? For example, the use of a car, free or discounted flights, discount on property or services, vacations, memberships in social or country clubs, tickets for entertainment and sporting events. So things like that. All right, so some of the taxable payments to employees, Again, this is discussed in your textbook, more on page, let's see, where is it at here? Taxable payments. This is on page 3, chapter 4, page 3. So disabled workers, wages withheld for wages paid after the year in which the worker became entitled to disability insurance under the Social Security Act. Drawing account advances, advance payments to salespersons against their commissions or unearned salaries for which they are to perform services, but for which they are not legally obligated to repay. Gift certificates considered cash equivalent and therefore are also taxable. Meals and lodging, unless furnished for the employer's convenience and on the employer's premises as a condition of employment, cash allowances for meals and lodging are taxable. Moving expenses, non-qualified, reimbursed, and employer-paid expenses are subject to withholding. Partially exempt employment, if the employee spends half or more time in a pay period performing services subject to employment taxes, all of that pay period is taxable. Payments to non-resident aliens, subject to withholding unless expected by regulations. Scholarships, cash or reduced tuition is taxable if paid for teaching, research, or other services as a condition of receiving the scholarship. Sick pay, subject to withholding, whether paid by the employer or third party. Supplemental unemployment compensation is taxable to the extent it is includable in an employee's gross income. And then travel and business expenses for taxation. The employee is not required to or does not substantiate expenses with receipts, or the employee receives travel advances and does not or is not required to return any unused amount of the advance. So fringe benefits, we talked about some of these already, but specifically some of the fringe benefits subject to income tax withholding, fair market value of the benefits minus payment by the employer. Examples of non-cash fringe benefits, again, tickets to athletic events, athletic club membership, personal use of corporate car, frequent flyer miles, vacation. And then some of the fringe benefits that are specifically excluded, qualified employee discounts, use of on-premises athletic facilities, reduced tuition, meals, and lodging for the employer's benefits, or de minimis fringe benefits that do not cost a great deal of money. The de minimis, and it talks about this on the bottom of page 4. It says any property or service, the value of which is so small that accounting for it would be unreasonable or impractical, is labeled as the de minimis fringe benefits. And so how to withhold federal income tax on fringe benefits. The value of the fringe benefits is what it's based on, and we generally withhold tax at supplemental wage rate or flat rate of 22%. Or we value fringe benefits and add to regular wages so that it's treated as one paycheck and withhold on the total. Flexible reporting of fringe benefits, option of treating benefits as being paid one or more dates in the same calendar year. So the example it's showing us, we can add the entire $2,000 value of a country club membership to one pay period, basically, or we can add 500 to 4 different paychecks type thing. All right, federal income tax withholding on tips. Employees must report cash tips to the employer by the 10th of the month following the month of the receipt. Employer collects income tax and Social Security taxes on these reported tips. In food and beverage establishments with more than 10 employees, employer must allocate tips. If total tips reported by employees are less than 8% of the establishment's gross receipts, and the allocated tips, reported tips minus 8% of gross receipts. So gross receipts should exclude carryout sales and those that already have 10% plus service charge added. So employer is not required to withhold taxes on allocated tips, only reported tips. Tip allocation can be done using one of three methods. So hours worked, gross receipts, or good faith agreement. Traveling expenses, reimbursement of traveling expenses to an employee paid under an accountable plan are not subject to federal income tax withholding. An accountable plan is an approved plan that must meet 3 IRS sanctioned rules. And the 3 rules are that they must be connected to the business. They must have adequate accounting within a reasonable time period, and the employee return of excess of substantiated amounts. Also, just like it shows here, if there is no plan in place, travel reimbursements are made under a non-accountable plan and considered wages. Therefore, the employer should withhold federal income tax withholding, or withhold federal income tax rather. Payments exempt from withholding. So there are laws that exclude certain payments, such as payment received by church ministers for their services, advances for travel and other business expenses, educational assistance if it maintains or improves job status. And it shows here that amount is $52.50 per year of the employer provided assistance for undergraduate and graduate is tax-free. Moving expense reimbursements for active military, and then transportation in a commuter highway vehicle / transit pass up to $265 per month. So on page 4.6, it gives us a more comprehensive list of some of these. So we talked about advances, accident and health insurance payments, deceased person's wages, dependent care assistant, domestic service, educational assistance, employee business expense reimbursements, employee safety and length of service awards, employer provided parking, foreign service by U.S. citizens, group term life insurance costs, health reimbursement arrangements or HRA, long-term care insurance premiums, ministers of churches, members of religious orders, public officials, retirement and pension plans, sickness or injury payments, transportation in a commuter highway vehicle, and transit pass. So, again, there is a more comprehensive list on page 6 of your textbook. Okay, pre-tax salary reductions are exempt from federal income tax. So contribution to cafeteria plans, and again, they talk about these more on the top of page 7. Cafeteria plans are plans that employees can select various levels of health, accident, and life insurance coverage, or choose to contribute to cash or deferred plans. Contribution to flexible spending accounts in 2019, the employee can contribute up to $2,700 pre-tax dollars per year into an account for out-of-pocket healthcare costs. This amount is a little bit higher now, or was raised a little bit in 2020, I think it was like $3,200 or something like that. But these are meant for individuals that know they're going to have a large amount of out-of-pocket medical expenses. Health savings account, if employee has a high deductible health insurance, they can contribute annually to a health savings account to meet the out-of-pocket medical bills, or Archer medical savings accounts for employees of small businesses that have high deductible insurance plans. Cafeteria plans, as I mentioned on the previous slide, accident and health insurance, self-insured medical reimbursement plan, group term life insurance, dependent care assistant, health savings accounts, are all benefits that could be included in the plan. Benefits that cannot be included: transportation, fringe benefits, educational assistance, scholarships and fellowship grants, meals and lodging for the convenience of the employer, dependent group term life insurance or deferred compensation, except for 401k contributions. Tax deferred retirement contributions exempt from federal income tax. So contributions to tax deferred retirement accounts are money set aside from current paychecks that will be paid out to employee upon retirement. So the types of retirement plans, contributions are made from pre-tax dollars or gross wages. So 401k, 403b, 457b, or simple plans. And so just like your book tells us, the 401k plans, this is the standard tax deferred retirement plan. 403 is a plan for employees of tax exempt organizations. 457B is a plan for employees of state and local governments. And then the simple plans are for a small company plan for a company with up to 100 employees. The employer can offer a simple plan as part of a 401k plan. This plan allows employees to contribute a percentage of their pay toward retirement. And then IRAs, or individual retirement accounts. In 2019, depending on certain conditions like age, for example, an employee can contribute the lesser of $6,000 or 100% of pre-tax income to a retirement account. Different limits if self or spouse are active participants in qualified retirement plan at work, and additional makeup amounts allowed to be contributed if age 50 or older. Roth IRAs are used for non-deductible contributions. So IRAs are a pre-tax, so you pay into an IRA with your pre-tax wages. Roth IRAs you pay into with your out of your net pay, or with your take-home pay, basically. Okay, withholding allowances. We've seen the Form W-4 before. We're going to look at some more examples of it. In fact, I think the next slide shows us an example of it. But basically, when an employee is hired, they have to fill out a Form W-4. This Form W-4 lets us know how many withholding allowances the employee is claiming, and then also if they're married or single, so that we can use that to determine their federal income tax. So it says best for employee if federal income tax withholding equals tax liability. The goal is no refund and no tax due. So the employee completes the W-4, and again, we're going to see an example on the next slide. The W-4 identifies number of withholding allowances an employee can take, one allowance for self and each qualified dependent, one allowance for each dependent other than spouse. And then there's also special withholding allowances that are discussed in your book. And I'm just trying to tell you. Okay, so this is page 10 of chapter 4. Employees can also reduce the amount of withholding by claiming a special withholding allowance, whether or not they plan to itemize deductions on their tax return. An additional withholding allowance can be claimed by a person under any one of the following situations. So a single person who has only one job, married person who has only one job with a non-working spouse, or person's wages from a second job, or the spouse's wages, or both, that equal $1,500 or less. It says this allowance is only used to compute the employee's income tax withholding. The employee cannot claim this allowance on his or her income tax return. All right. So completing the Form W-4, and I thought, okay, so it's the next slide, sorry. So completing the Form W-4, again, the employee has to choose single or married. but withholding at higher, so single, married, or married, but withholding at a higher single rate. Exempt status can be claimed if the taxpayer had no income tax liability last year and none is expected this year. The exemption is only valid for 1 year. After that, a new W-4 has to be filled out. Person can't claim exempt if they are a dependent on someone else's tax return, if their income exceeds 1,100, or if unearned income less than 350, but total income is greater than 12,200. So just like it tells us in the book, if someone's wages, the standard deduction is 12,200. So if someone's wages are below 12,200, they are not going to have any federal income tax due. So, all right, here's an example of that W-4, and let me just blow up on it a little bit so we can look at this. So you see, obviously, the personal information, name, address, social security number, and then box 3 here, whether we're single, married, or married but withholding at higher single rate. And then number 5, this is kind of the next most important thing, the number of allowances they are claiming. And so, if this person is single and they're claiming 4 allowances, that might lead us to believe that they have 3 dependent children, right? So they'd be claiming 1 allowance for themselves and then 3 for their dependents type thing. And then on line 7, this is where we would claim exempt if applicable. Again, most of you have probably filled one of these out before. If you've ever had a job, you're required to fill this out at the start of a new position. And the information can be updated. Like, for example, this person claimed 4 allowances. Well, at the end of the year, when they, or I guess I should say maybe at the beginning of the next year when they filed their income tax return, if they ended up owing because they had so many allowances, then they might want to reduce those allowances, right? And in that case, a new W-4 has to be filled out. So other situations on the W-4, if employee doesn't provide a completed W-4, employer must withhold as if the employee is single and has 0 allowances, which then would have the highest amount of taxes taken out. Employee can change the W-4. We talked about this a moment ago. So when the employer receives an amended W-4, they have 30 days to replace the form. Employee must change within 10 days for decrease in number of allowances. If there is an increase in the number of allowances, they can change or leave their current W-4 in effect. Additional or voluntary withholding agreements. We can withhold additional federal income taxes if we wanted to, by reducing the number of allowances or specifying an exact amount to be withheld in addition to what would usually be withheld. Employers can establish an electronic W-4 system, but must provide paper option if employee requests the paper option. Unauthorized changes or additions invalidate the W-4. Employers should submit the W-4s to the IRS when requested, and penalties imposed for willfully and falsely filling out the Form W-4s can include fines up to $1,000, imprisonment for 1 year or both. Employees subject to $500 civil penalty for claiming excess deductions. All right, federal income tax withholding on other income sources. So pensions in excess of $24,396 per year. We withhold as if the recipient is married and claiming 3 allowances unless the employee chooses to have no withholdings or a different amount to be withheld. Payment of sick pay by third party. And for the pensions, then we would use the W-4P. For the payment of sick pay by a third party, it's the W-4S. And then for government payments, such as Social Security benefits, it's the W-4V. Employer calculation of federal income tax withholding. Again, we have the wage bracket method or the percentage method. These are the two most commonly used methods. There are other methods that are rarely used for withholding, but all of these methods require us to know whether the employee is single or married, how often they get paid, their gross pay, and their number of allowances. All four of those items, marital status, um, how often they're paid, gross pay, number of allowances, help to determine or are necessary to determine the federal income tax that'll be withheld. All right, so vacation pay, treated differently than other supplemental wages. We withhold as though it were regular payroll. If vacation pay is in lieu of taking vacation time, we treat as regular supplemental wage payment and calculate tax on total as single payment. Supplemental wages paid with regular wages, so each type of wage not indicated specifically by employer. In that case, withholding by employer as it were a single regular payment for the payroll period. Or if each type of wage is indicated specifically by the employer, we can use flat rates for the supplemental wages and then regular withholding rates for the regular earnings. So 22% flat supplemental withholding, 37% flat withholding for amounts in excess of 1 million. Okay, gross up supplemental wages. What they're talking about in this is, for example, if we want to, give somebody a $7,000 bonus and we want the check to be for, well, I said 7,700 in this example. We want to give someone a $700 bonus and we want the bonus check to be for 700. What we have to do is we have to figure how much would be charged for the supplemental wage rate, for the Social Security or OASDI tax rate, for the hospital insurance tax rate. And basically we have to add those amounts. So if we want to give someone a $700 net bonus check, we actually need to process the payment for $995.02 of wages, so that by the time we subtract these amounts, then the check will end up being 700 basically. So when we're, when we talk about gross up supplemental wages, again, we're looking to give a set amount, $1,000, for example. So then we need to add all the taxes to it to get the gross amount, right? If we want the net to be 700, we've got to add the stuff back in then to get to that gross amount. All right, wage and tax statement form W-2. So every, at the end, and so what, 2020 ended not too long ago. Now we're in 2021. And so by January 31st, if any employee worked during 2020, by January 31st, 2021, their employer would have sent out their W-2. And so the W-2 is what is used for individuals to prepare their 1040s or their individual income taxes, right? So employers are required to furnish the Form W-2 to employees and send copies to the federal, state, and local governments. The W-2s report wages paid and the amount of taxes withheld. We're going to see an example of this on the next slide, but employers are required to send a hard copy to the employee on or before January 31st, or they can also give these forms to employees electronically, but the employee, it has to be a secure website and the employee has to be given the information to access it. And then just like it shows here, if a company is issuing more than 250 W-2s, it must file electronically using the Form 4419. Instructions for completing the Form W-2 are found on pages 24, 25. Various penalties for filing incorrect or late W-2s are discussed on page 426. When the W-2s are completed, then a W-3 is prepared, because remember, The W-3 is the combination of all of the W-2s that were reported. So, just to make the math easy, let's say that we have 10 employees and these employees make $100,000 a year, right? When we prepare our W-3, we're going to list 10 employees and then total wages are going to be 1 million, right? 10 employees times 100,000 a year, right? So the W-3 is the combination of all of the information on the W-2s, all of the, data from the W-2s is compiled onto the W-3. And so it says this is transmittal form. The total of the employer's forms 941 must also tie to or equal to the numbers that we have on the form W-3. And then if any of these forms, the W-2 or the W-3, need to be corrected for errors, then they have available the W-2C and the W-2-3 for correcting errors in previously filed W-2s and W-3s. So here's an example of that W-2. Again, for any of you that have had a job before, then you received one of these in the mail. You've probably seen one of these before. Basically, it's showing our total wages, tips, and other compensation, the federal income tax withheld, the Social Security income tax withheld, the Medicare income tax withheld, taxable Social Security wages, taxable Medicare wages. Now, in this case, all three amounts are the same. However, sometimes they can be different because like we learned about, payments into certain retirement plans are not taxable through federal income tax. So we might have, the numbers might vary a little bit or be a little bit different based on that information, but otherwise not too bad. Again, this is what is prepared by the employer and sent to the employee following the end of the year, and they're required to be sent out by January 31st. Okay, so some of the returns that we have to file quarterly or informational returns. So employers must file returns that report amount of quarterly wages and amount of taxes withheld. And we're going to look at some examples coming up. And then employers must file information returns to report compensation paid to non-employees. This is like the form 1099 for miscellaneous income or interest revenue or dividends and things like that. And so these information returns are meant to report tax liability for non-payroll items such as backup withholdings, which occur when an individual receives interest, dividends, and certain other payments and fails to provide correct taxpayer identification number, or withholding on gambling winnings, pensions, and annuities. So here are some of those different forms. They talk about these in depth on page 429, page 430. But this Form 91, we've gotten practice with this before. This is for reporting the federal income taxes withheld, as well as the employee's portion of FICA taxes and the employer's portion of FICA taxes, right? Form 943, very similar, but this is the employer's annual tax return for agricultural employees. The Form 944, the employer's annual federal tax return. These are for employers who owe $2,500 or less in employment taxes for the year. And then the Form 945, annual return of withheld federal income tax. This is used to report tax liability for non-payroll items, again, such as backup withholding and withholding on gambling winnings, pensions, and annuities. And then we get into the 1099s. These are on page 430, chapter 4, page 30. And so as we can see, there are different 1099 forms depending on what type of income it is. So the 1099 DIV is for dividends and distributions, for reporting dividends totaling 10 or more to any person. The The 1099-G is for certain government payments for reporting unemployment compensation payments, state and local income tax refunds of $10 or more, taxable grants, income tax refund, and agricultural subsidy payments. The 1099 INT is for interest income, reporting of interest income of $10 or more paid or credited on earnings from savings and loans, credit unions, bank deposits, corporate bonds, interest of $600 or more from other sources, forfeited interest due on premature withdrawals of time deposits or foreign tax eligible for the recipient's foreign tax credit withheld. The 1099 MISC is the miscellaneous income for reporting miscellaneous income such as rents, royalties, commissions, fees, prizes, and awards of at least $600 paid to non-employees. And then we have the 1099 R, distributions from pensions, annuities, retirement, or profit saving plans. And then the form 5498 for reporting contributions received from each person to an IRA or simplified employee pension plan. And then the form 8027, this is for large food or beverage establishments to report to the IRS the receipts from food and beverage operations and tips reported by employees. So again, just some of those different forms or returns filed by employers. All right, so 1099 miscellaneous is probably the most often used 1099, and again, it's used if we made payments to non-employees in the amount of 600 or greater. So namely independent contractors or people that are self-employed will get 1099, for example, for anything over $600. So independent contractor must submit taxpayer identification number on the W-9 to the hiring agent. If this is not done, then the hiring agent must withhold federal income tax equal to 24% of the payments made to the independent contractor. And non-payroll items like withholding on military pay, pensions, or IRAs, again, are reported on that form 945. Here's an example of what that 1099 looks like. Very similar to the W-2, but again, we've got some different boxes here. Rents, royalties, other income, federal income tax withheld, fishing boat proceeds, medical and healthcare payments, non-employee compensation, substitute payments in lieu of dividends or interest, right? So we've got some different things that can be used on this. All right. Withholding of state and local income taxes. So 3 different methods used when withholding state income tax. Either the full taxation method, the leftover taxation method, or the reciprocity method. And so it talks about these more, and let me tell you what page. This is on page 32. So full taxation is when we're going to tax wages based on both the resident state and the work state. We calculate the taxes without any credits. The leftover taxation is we pay the full tax to the work state and then pay the rest to the resident state. And reciprocity, withhold only for the work state or resident state, depending on the reciprocal agreement between the states. So in states with state income tax and localities with local income tax, generally the payroll department is required to file periodic withholding returns to report wages and withholdings, to prepare reconciliation returns to compare deposits to withholdings, send annual statements to employees to report annual wages paid and applicable taxes withheld, and then to issue information returns to report any payments to individuals not subject to withholding. Okay, that was our last PowerPoint slide. So again, hi guys. We will get started doing some of these calculations together on Monday, and I look forward to seeing you guys then. As always, just let me know if you have any questions once you have a chance to read the chapter or view this recorded lecture, and I will see you guys soon. Bye-bye.